In this lecture, we're going to use the cost, volume, profit, income statement that we learned about in a previous lecture. We're going to use it to do analysis to determine things like break-even point, the level of sales that are needed to get to a certain profitability, and we'll learn about sales mix too. In order to do that, we're going to use Margie's Custom Silkscreen as an example company. Margie's business is to print out silkscreens in order to make custom-made t-shirts to order. Margie sells her t-shirts at $35 a piece. She has a variable cost of $21 for every t-shirt. As you might recall, variable costs are incurred when Margie has a sale, when she needs to produce one of her t-shirts. So in her case, the variable cost would include the t-shirt itself and then the ink that's used to do the silk screening. When you subtract that, you get $14 that's left over. At this point, Margie is selling a quantity of 550 t-shirts. So her sales are totaled at $19,250, and I got that by taking the 550 t-shirts times $35. And then the variable cost, they are incurred every time she sells a t-shirt. Since she sold 550 t-shirts, she had $21 each t-shirt, so the total variable cost is $11,550. That gives her what's left over as the contribution margin, which is supposed to be how much you have left over to contribute to the fixed cost and leave the rest for profitability. Since her fixed costs are $7,000, then she's left over with operating income or profit of $700. As you recall, fixed costs would be something like rent of the building or the salary of the manager of the silkscreen shop. So those are all fixed costs because she has to pay those whether or not she sells any of her shirts at all. Let's take a closer look at variable and fixed cost. Remember, those are considered cost behaviors. So a cost that is incurred only when Margie makes a sale is called a variable cost. So you can see that if she sells one more shirt, 551 shirts, the variable cost goes up by another $21. If she sells one less shirt, 549 shirts, that would be $11,529 in variable cost. It's 549 shirts times $21. So you notice how you can see the variable cost increasing incrementally every time she makes a sale and has to produce a shirt. The fixed costs are not changing. That's her rent, her salaries to her manager, that kind of thing. And you notice that they stay the same. $7,000, $7,000, $7,000, as long as she's within the relevant range. One of the terms that we need to get familiar with is called the contribution margin ratio. The contribution margin ratio is the percentage of the contribution margin as compared to the sales. In other words, for every dollar in sales, how much is left over as a contribution margin. And you can get that by taking the contribution margin and dividing it by the sales. So notice, if you take the contribution margin of 14 and divide it by $35, you get 40%. So that's the contribution margin ratio. And you can take the contribution margin ratio from any level of sales. So let's take it from, let's say, 549 units. So if you take the contribution margin at 549 sales, which is $7,686, and divide it by the sales at that level of $19,215, you still get 40%. So as long as you take any contribution margin, divide it by any sales, as long as it's the same level of quantity, you'll get the same percentage. So basically that just shows you the percentage of the contribution margin to the sales. So if the contribution margin is 40%, then that means that the variable cost must be 60% of the sales. And that's because the variable cost and the contribution margin together add up to give you your sales revenue. So if one is 40%, the other one has to be 60%. We can determine that sales units must equal the fixed cost plus the operating income divided by the contribution margin. When we use this, we can make a lot of analysis, and one of those key analysis we can make is called break-even point. The break-even point is the minimum number of sales needed in order to cover all costs. This is a really important number to understand for the management team. By understanding the break-even point, they understand sustainability. It helps the managers, investors, creditors, anybody really that's trying to understand the company, determine what is needed in terms of sales in order to break even. We can think of this as sustainability of the business. How will they sustain themselves over the long run of the business? Since break-even point is equal to zero profit or zero operating income, right? In other words, that's the minimum number of sales that are needed in order to cover all your cost. So once you cover all your cost, you're at zero profit. You're not at negative profit, which is good, but you're not at positive either. You're at zero. And we can change the operating income to zero, and so the formula becomes fixed cost plus zero divided by the contribution margin, or in math we just get rid of the zero and we say fixed cost divided by the contribution margin. So using the numbers that we have available to us, the fixed costs are $7,000, $14 is the contribution margin, and 500 shirts would be the result. So if Margie sells 500 shirts, she'll cover all her costs. And again, that shows her what kind of level of sales she needs to get to sustain her business. So let's look at this example. Let's say she only sells 480 shirts. Her net income was negative $280. So the reason is because her contribution margin was below the fixed cost. The problem is that she still has to come up with the $7,000. So what she needs to do is find a way to come up with that extra $280. So she could invest it from her savings. She could save up profits from previous months. She could take a loan out. She could get another investor. Those are all options for her. But if you think about it, those are only short-term options. In the long run, a manager or an owner of a business can't continue to take out loans or put money into a business that doesn't break even. So this allows her to understand what kind of situation she's in and where she needs to get in order to sustain her business. If she gets to 500 shirts, it might not sound like fun to make $0 profit, but she's at least covered her cost and she can at least be around for the next month in order to try to make a profit then. So what about if she wants to target a profit? Let's say she wants to get to a profit of $4,900. Well, now instead of putting 0 as the targeted operating income, we're going to put 4,900. And so that means she needs to sell 850 shirts. So this allows her to see what kind of sales she needs to get to in order to get to the targeted amount of profitability that she wants to get to. Sometimes managers want to determine the break-even point in the amount of sales dollars instead of the amount of units they need to sell. So in the case for Margie, maybe she wants to know how much sales in dollars she needs to have in her cash register, or her bank account from sales. It's just change the contribution margin to the contribution margin ratio. So instead of using 14, we're going to use the percentage that we found in the contribution margin ratio. So using the 40% that we found earlier, we see that she needs to sell $17,500 worth of merchandise in order to break even. And you can use this to target sales in dollars instead of sales in units. In other words, the only difference between targeting sales in dollars versus units is you change the contribution margin to contribution margin ratio. So 7,000 plus the targeted income of 4,900 divided by 40%, which is the contribution margin ratio, gives you 29,750. So that's the sales that she needs to collect. Let's look at this on a graph just to kind of get a big picture understanding of what break-even point is. We'll graph all the variables, fixed cost, variable cost, and the sales. Let's start with the fixed cost. So we'll start out with the fixed cost and we'll put it as a straight line across. So in the case of Margie, it would be $7,000. Next, we'll graph the variable cost. Now, the reason I started out with variable cost at the fixed cost level is because we want to look at the total cost, which is the variable cost plus the fixed cost. So we're going to start out at 0 units of sales, and at that level the variable cost would be 0, but the fixed cost would be $7,000. Then as we make more sales of t-shirts, the variable costs are going to creep up. When we add the sales in there, we see that at some point the sales are going to overtake the variable cost. At the point where the sales equal the variable cost plus the fixed cost, that is where our break-even point is.